Welcome back to K-Ratio's Weekend Preview. I'm Kyle Lintner and I'm here today to provide actionable insight for the future, not recap the past. In this week's episode, the day has finally arrived. The great bull market of spot rates has officially come to an end. We'll break down what that means for you this week, but first let's take a look where the freight market currently stands. Not quite what one might expect after hearing a bull market is over. The National Outbound Tender Volume Index continues to spend all of 2021 hovering around 14,000, now at 14,006, still some 40% higher year over year. Also curiously not in line with a call to the end of a bull market, national tender rejections remain elevated at the recent magnet of 21%, 3 times higher than this point last year and 4 times higher than 2019. Still more bullish, the implied accepted tender index sits 17% higher year over year. All of this gets us a truck stop national average, though down 14 cents from last week, at $2.71 a mile, which is roughly where we spent last August, and a whopping 67 cents higher year over year. Tenders remain at historic levels, rejections are single digits off all-time highs, accepted tender volumes still far exceed historical total tender amounts, and rates are beyond anything previously seen prior to 2020. How can this be the end of the great bull market? Because today we find ourselves with DAT contract rates at $2.40, now 2 cents above spot rates for the first time since July, and the two rates are headed in opposite directions both against each other and compared to last summer. It has been 6 months since we first told you to buckle up for a long ride much higher, and today we're here to tell you the beginning of the next phase in the cycle of freight rates is underway. Spot rates are officially in correction mode, now 51 cents off the peak, though don't expect the slope of the descent to be quite so severe. At the risk of sounding too much like 10th grade geometry, when it comes to price movement, the rise is never greater than the run, and the inverse holds true as well. During the rally, we experienced pure price discovery to the extent that historical levels of trucks and trailers were ordered, and contract rates were bid hard and fast. That last part is the reason why spot rates now drift lower, but also why spot rates will not plummet. High contract prices, in addition to strong freight volumes and periodic bouts of capacity dislocations, will keep spot rates moving sideways to slightly lower for much, much longer. Last week, we highlighted all of the major outbound LA lanes that now have contract rates exceeding spot, and while that still holds true, so does the excess LA volume. This chart of the nation's largest market by volume, neighboring Ontario, has tender volumes for 2020 in blue and 2019 in green, and clearly shows when all of that imported cargo started to work its way through the domestic supply chain in mid-summer. We can see that business again begin to pick up on the right side of the chart, which comes as a record 55 ocean cargo vessels with an estimated 300,000 containers are still waiting just to dock in LA or Long Beach. That backup and the delayed flow of goods has pushed freight that is ready to go past any option beyond long haul over the road. This chart of rejections for loads longer than 1,000 miles out of Ontario in blue against rejections for all loads out of Ontario in orange also shows us when imported goods took hold after national lockdowns as demand required long haul over the road, and it shows this spread is now widening again back out to the widest margin since peak holiday push in November. Despite going contract, all of this freight and its length of haul will keep LA in the driver's seat of the nation's supply chain and cause repeated imbalances to individual markets' supply and demand conditions. Now, what does this mean for freight this week? Carriers, where you end up now matters more than ever. On average, rates nationally are coming into balance, but averages disguise the outliers both high and low. The safe bet is to go to markets of volume, as volume holds the key to the spot contract relationship. Think lanes between major population cities with heavy outbound volume like Chicago, Atlanta, LA, as those combinations will keep the wheels moving and at a good rate. Brokers, two things. First, longer term, you need to get competitive with your RFPs or you're not going to have a job. Shorter term, OD pairs matter again, so you need to pay attention. Nationally, tender rejections might be at 21%, but Memphis is at 35% and Omaha is at 42%. Those matter when you quote spot and cover RFP, both for different reasons. Shippers, like I said earlier, prices are not going to fall out of bed, but after they consolidate, it will be price discovery to the downside. I'm not advocating for you to force liquidation of all the shiny new toys seemingly every carrier just purchased, but if you're lucky enough to have an annual RFP coming April or May, you will find out just how low a 3PL is willing to go. To stay current with everything freight, or for more information on all of our products, including our award-winning freight intelligence platform, so your margins do not end up where they are today, check us out at k-ratio.com. Please stay safe, and thank you again for watching.